if there's anything within there that you want a further explanation of, I think a quick 5-minute overview on the first half of the presentation, I think that'd be a good idea. Michael, what do you think?
Yeah, no problem. I mean, I don't want to fill up an hour because we have to.
Yeah.
I'd rather this be completely conversational, interactive. If it takes us 20 minutes, great. If it takes us an hour, great. But you know, let's just try to help you. So,
okay.
So Adam,
I think,
are there?
Yeah. I'm sorry. I was going to say, I think answering Adam's question, because it was really, you know, now heading post-graduation and heading into the workforce, what are the areas of focus that I should be placing my money, right? Like, where should I be actually investing my money?
Yes.
And
yeah.
so,
Exactly.
so I think the first slide, one of the first slides that we have, goes into that well, in terms of, and we'll keep it very informal again and going about it this way, but let me see. These are the 4 main areas that, in our opinion, postgraduates should be focusing on. Now, obviously, as you get farther and farther into your careers and acquire houses and other assets, these are going to evolve. But to help build the strongest foundation possible, once you first start earning an income, these are the areas that we feel you should be allocating your funds. So one, we'll break them down really quickly. Creating an emergency fund. So we'll go over that. Basically, creating an emergency fund means growing cash on hand, right? You want to have roughly 4 to 6 months of your monthly expense. So going through, actually finding a budget, creating a cash flow, meaning that we have resources here, but it's basically just keeping a track of where are you spending money, right? Understanding how much money you have coming in after taxes, after contributions. That's step 1. Step 2, where am I spending all my money? So we'll provide you with this resource after this session, but it's going to be able to help you basically track how much do I spend on groceries, on rent, whatever it is. Find out what you spend on a monthly basis, and then that will help you to find your monthly savings. So that's step 1, right? How much can you actually save? And then once you get to that point, that's where you start to allocate into different areas, right? The first one being that emergency fund. You need cash on hand. So once you know how much you spend per month, start to try to save up 4 to 6 months, whatever makes you feel comfortable, but have that sitting in cash. You don't want more because of things like inflation. And again, inflation is the ever-changing value of the dollar, right? So money back in 1920 was worth a lot more than it is today. And so what we have to fight is putting our money into areas where it's going to be earning interest, earning value, so that it can combat that de-escalating value of the dollar, right? We'll get into that. That's one of the main topics we're going to be touching on, or we can touch on, is the investment side, right? But grow cash on hand, have that as a safety net. Number 2, and this gets into some of the investments, grow a wealth investment account. That's just our coined phrase for put money in a general individual account, a brokerage account, an advisory account, whatever it is. This is getting your money exposed to the market because, again, going back what we just said, if it's sitting, you know, in terms of money is just sitting in cash, it's going to be actually constantly losing value. So actually, this is the best slide. It's going to be constantly losing value. Whereas if it's invested in the market and it's responding, it's going to be growing with the market, and you'll actually have a profit and an increase in your dollar. So this is inflation, what we're trying to fight. So back in 1974, a dollar back then, if it just remained in cash, it'd be worth 16 cents today. Or if you put $1 in the market back then, 1974, it'd be worth worth 154 today. That's the idea we're trying to get across, right? So 1, cash on hand is a safety net. 2, money invested so you can combat things like this, inflation, and take advantage of things like compounding. Right? We want our money to double on itself. And then one of the last core areas is getting your money within an investment account, a retirement account rather. Without moving too fast, this is that traditional versus Roth option. And we can go dive into that deeper. That could be one of the topics, but I want to potentially open it up for other people to ask about different types of investments, everything like that. The idea, and the one thing that's just crucial, especially because I know we have a lot of international students here, for non-residents, something to focus on is this. These retirement accounts, and we can get into it further, come with great tax benefits. But because there are tax benefits, there are requirements. For instance, we can't touch whatever funds we put into here until the age of 59 and a half. So as soon as we turn 59.5, you can access the money without any penalty. If you, let's say you try to access at age 40, you could get the money, but there's a 10% penalty and you have to pay income tax on it. So we don't want to try to do that. The reason I'm bringing all that up is this. Some countries require that when you leave the United States, go back home to your original country, that your accounts be liquidated and then be put into your origin country's domiciled investment accounts. So if that is the case, if you start to build a company 401k and all of a sudden you go back to your home country and they make you liquidate your account, there's the potential to have to take on that massive tax burden, that massive penalty, because you're going back home. So just something to take into account of. There's also workarounds for that as well. Just keep that in mind and seek the advice of some professionals as well. But that's honestly a quick overview on where we left off from the last session. Now I want to get back to the open forum that we're having going on right now, and Adam, I hope that helped to break down some of the information really quickly. There's a lot more detail on the recording that we have, but that will help to give a quick overview on the three of the four core areas where you should be putting your money.
Right. Yeah, definitely. I think I've got a good sense of the where my money would be going. I have a question about the third one. The retirement account. Is that the I heard about like 401k, the Roth IRA. Is that related?
It's exactly that. Yes.
Okay.
So when it comes to, and real quick, and I can definitely dive into that, but I know that was one of the last subjects we touched on, so we can bounce around. We can come back to that for sure and touch on it more. Jacob, Tinwayne, did you guys want to potentially ask any questions? That way we can keep everyone captivated with different topics. Or Jeremy, Khaled, is there anything that you guys wanted to maybe touch on before we keep going over the same material from last time?
I can say something quickly. So hi, all. My name is Jacob. I think I'm maybe a little ahead of Adam in my financial literacy. Currently, honestly, with all of the savings that I have that aren't being spent on a Cornell Tech tuition are in a Vanguard like S&P 500 fund. But hopefully once I actually get an income after school, I'll be able to maybe invest a little more aggressively. And I guess I was kind of hoping to get some sort of portfolio allocation recommendations from you guys. So it's not all just in one asset class, but I know I should be investing pretty aggressively. I just don't know what that should look like in terms of percentages and industries and how to divide it up.
So great question. And Michael, I'll let you talk a little bit about that too, but I'll take it at the beginning. One, when it comes to giving exact asset allocation models, we can't give sweeping statements, right? Because every single strategy, every single model is going to be customized for a person's actual needs, right? So it's something we can get into, and if this is something that you'd want further insight, feel free to reach out to us and be more than happy to actually sit down and break down an actual percentage by percentage basis. But the overarching concept and what you want to try to accomplish when you start investing, and I think you hit the nail on the head when it's being aggressive at a younger age, because we can afford to be more aggressive, take some more risk in certain accounts, like for instance with your retirement accounts. If mentally we're not going to touch it until age 59.5, we can afford to be fully invested in stocks, or 90% in stocks, 10% in bonds, those kind of things, right? But for accounts where it's a general investment account, right, where money's still accessible to us at any time, and maybe there's a 3 to 5, maybe even 10-year time horizon, right? We want to use whatever money goes into that account for a down payment on a house. Because it's a shorter time horizon, we don't want to take as much volatility because we have shorter time to recover. So with those types of accounts, you may want to pull back a little bit and look more into a 70-30 model. And when I say 70-30, 80-20, 90-10, that's the breakdown between stocks and bonds. We can get into the distinction between that. Stocks are more aggressive, bonds are more conservative. And then lastly, Jacob, before we kind of get into the more nitty gritty of your question, the last thing to really dive into, and I think this slide helps to emphasize that, is diversification. So let me actually, it's better when shared like that, is diversification. So you even said it, getting exposure to all different types of asset classes and what percentage is really best, right? So again, we'd be happy to meet with you and kind of get into more of the specifics regarding percentages. But this is the overarching idea. You want to get exposure to every single one of these different asset classes. Asset classes meaning the way that stocks are categorized, right? Large cap, small cap, mid cap, value versus growth, international versus commodities versus REITs versus real estate. You want to find that allocation background that's going to give you the proper amount of exposure to all these different areas, so that while over here in 1 year, cash is the lowest performing asset class, in the very next year, it's the highest, right? Or over here where commodities back in 2005 were the highest performing, shot down to the lowest performing, and then shot back up to the highest performing. You constantly want to be exposed to, guaranteed after every single year, you at least have some form of exposure in the highest performing asset class. It will balance out your overall returns and make sure that your portfolio doesn't do this, but more of this. Michael, you want to tackle this a little bit?
Just a couple comments. I agree with everything you said, Chase. You mentioned specifically a Vanguard S&P 500 fund. So I'm just going to make a couple of comments to help you think a little bit bigger picture. S&P 500 is absolutely diversified compared to owning a couple of names. There are actually 505 individual stocks in the S&P 500. But a couple of comments I want to make. The first is many of those stocks are global stocks headquartered in the US. So they do have some exposure internationally, but they're still US companies. So number one is you are extremely overweight in a vacuum, just US companies. And there's a massive world out there of lots of good companies that you're just arbitrarily ignoring. So number one is you're not as diversified as you may think you are. Number two is that in North America, there are over 7,000 publicly traded companies. Not that all 7,000 you want to own. There are plenty out there that no one wants to own other than a few individual people who really believe in them. But you own 505 out of 7,000. You go to Cornell, you can do the math. It's not exactly as though you have that much exposure to the US economy. You only have exposure to 505 names out of over 7,000. And that's on the public side, not even the private side. And the last comment I give you is that the S&P 500, as I mentioned a couple of times, it's 505 names. It's got a silly name, and 500 at this point, but just know that when you say S&P 500, it's actually a couple more. But my point is that it's a cap-weighted index, and what that means is that I just read this the other day. The 41 largest stocks in the S&P 500 make up a larger collective market cap than the remaining 464 companies. So it's a very disproportionate impact on the index performance, meaning they're super large companies. So not only have I told you very quickly, you came into our emergency room and I started carving you up a little bit and looking under the hood. You're very much US centric. You don't have access to most of the economy in the US. And then thirdly, about 40 names, 40 largest names is really what you're invested in. So there's clearly a whole world and a whole community that you're not investing in yet that you really should be aware of. So I just wanted to make sure you were aware of that. And as you build out your infrastructure and your approach, just know you need to and should think bigger.
Yeah, first of all, thank you guys. And that's definitely a bit why I asked the question, is because, I mean, on the one hand, like, what is it? Like, it's 8% a year on average, and that beats 80% of hedge funds or something like that for the S&P 500, just staying in that. So that, I guess that's why I when I started this, I saw those stats and I said, all right, well, easy returns. I'm not going to actively manage this very much. So that was just an easy way to just get started. And I also got lucky, and I first started this account at the complete bottom of the COVID recession.
There you go.
So I just got, that was just a lucky time to turn cash into equities. No. But definitely taking that next step and saying, okay, I'm either gonna find more asset classes or different funds or even individual equities. That's like a much harder question, and it's hard for me to assess like what makes sense. And again, I don't really want to be actively managing it. So I guess how to think about doing those next steps is what I'd hope to get out of this.
Sure, and Chase mentioned there's a lot of personalization in this. So just a suggestion for you may not be appropriate for a suggestion for Jeremy, right? Or not appropriate to Adam, etc. So just know that there's lots of ways to approach this. There are some bad ways, unfortunately, and this is part of the deal you make with the devil, is you're not really sure which the best way is until after the fact. So I like low-cost index funds. I think they play an important role in portfolios. They just shouldn't be the only thing you own. And there are ways to access in a very cost-effective manner other areas of the economy. So I'm not sure if today's call, we're going to go through everything that's going to enlighten you on a personal level with that money, but hopefully it'll stimulate you even more to explore and think through kind of what that next step means for you.
Emphasizing also on what, building off what Michael just said in terms of how index funds, while great and will give you that diversification exposure, there are also other ways to become more customized, looking into funds like ETFs, exchange traded funds. And I know we talked about that, and that was a topic that was brought up by a lot of people in terms of wanting to learn more about it. So when it comes to it, ETFs were first created as a cost-effective strategy for a diversified portfolio that's not actively managed, right? So when it comes to mutual funds, mutual funds are portfolios that are actively managed by an investor, an advisor. And for that, they take on certain sectors. So you can find a technology mutual fund, you can find a life science mutual fund, a large cap or a international bonds mutual fund, and they'll specialize in that. And they'll customize the strategy off that, and you can get the overall average return of what they get. The great part about it is when you do that, you get diversified in terms of if you want to get exposure to 550, whatever it is, international bonds, you can do that through a mutual fund. But because it's actively managed, it's going to be a higher cost. For someone who's just starting off, and there are times and places for mutual funds, but for someone who's just starting off and really starting to find their own path through investing, ETFs are some of the easiest ways to cost effectively accomplish those diversification we talked about, to accomplish getting exposure to all different types of asset classes. Because you can go and do some research on, for instance, technology ETFs specific. You can look at large capitalization ETFs. Usually large cap ETFs will mirror the S&P 500. You can look at small cap ETFs. You can look at international ETFs, real estate ETFs. So you can start to get exposure to all those, diversify through ETFs, which are going to act similarly to mutual funds in terms of you will have the average return of the 50 or the 100 or the 150 stocks or properties that they're invested in, and get their average return. Looking into those different types of models is a good way to get exposure to all the asset classes cost effectively, and also at the same time accomplish diversification.
Perfect. Thanks, guys.
Yeah. And again, reach out if you want to get more specific. We can't get specific for your own personal situation right now.
Yeah, makes sense.
Yeah. Any other questions?
I actually have a question.
Yeah.
I have a question about the timing, because basically investing in index and diversifying is the best way to get rich slowly, as we saw in the previous session and as we discussed already. But I feel in terms of entering the market at a low level would be like the most optimal situation. And given the current context right now, given everything that's going on in Ukraine, and given also the problem, the questions about super high inflation and the decision from the Fed, from Powell, do you think that in the current context, it's better to wait and see, or lower down the investment and then higher the investments as soon as something happens, like potentially negatively or not? Like, what is your output on this?
Chase, excuse me. In our presentation, we have a slide that talks about the market timing. I think it's a great time to pull that slide up and we'll talk
Agreed.
to it.
Agreed.
And this is great, right? Keep these questions coming. This is awesome. I enjoy this a lot more. I don't like to hear myself talk.
Yeah.
So great. Perfect. So Chase, why don't you walk
Yeah.
through that slide? I think,
So
was there only one or two in this presentation? I can't recall.
there was only one in this presentation. Yeah. So
Great.
to answer your market, we literally have the slide in there. It's time in the market versus timing the market, right? And you already alluded to it, right? The long-term approach, the way to steadily increase your overall wealth is through diversification, putting it into these funds. But there is a sense of, you know, is there a good time to buy, everything else like that. The one answer that we have is if people knew how the market was going to react, then if, like, for instance, if we could tell you how the market is going to react tomorrow, then we would not be here. We would be on a yacht over in Miami and it'd be a blast. You know, so there's no rhyme or reason to it. It's a dull answer, but consistency at the end of the day is the best solution. So meaning this, a lot of people, and this comes into behavioral economics and the way people react to the market, most people's initial reactions, fight or flight, everything like that, is to respond to the market poorly in terms of when they see the market crash. And think about back in March 2020 when COVID first impacted the market, the entire market goes down by 38%. A lot of people's reaction is to sell. I want to get out of this. It's the market's getting crashed. I'm losing all this money. They want to sell. Or if all the money is increasing, there's a huge boom. Sometimes people's reaction is, oh man, I don't want this to go down. I want to keep this gain. I'm going to sell it. What they're doing there is selling low and buying high, which is the inherent opposite of what we're trying to do. So Jeremy, you were already alluding to it, you know, in those periods of dip, right, of negative return, most people, while some might be fearful, we have the understanding and knowledge that we know it's going to correct, right? There's going to be this correction, and it's honestly a great buying opportunity, right? So that's why you can take advantage of those discounted prices and get into it. That's one of the main benefits of our diversification portfolio is this. If the entire market is down by 38%, right, where the S&P 500 goes down by 38%, we recall S&P 500 is made up of the large capitalization stocks within the market. But our goal is we want to be diversified across all different types, small cap, real estate, whatever it is. So if the market goes down by 38%, consciously we have to realize that there are other asset classes that are helping us to raise our performance. So while the market's down here, we should hopefully be here, or maybe only -5, or maybe even the positives. So because we can help to mitigate, decrease that amount of loss, we can capture those moments as if you're referring to. Now, going and alluding more into the trying to time the market and only buying when there is a dip and everything like that, this graph here, this bar graph, shows the concept of timing the market. The market moves on in terms of drastically, day intervals, right? You can literally pinpoint the days from the past where the market made the most major movement. If back in 2001, if you put $100,000 into the S&P 500, if you just left it alone, then by the time that it was in 2020, 20 years later, that $100,000 would have grown to $420,000, a little roughly over it. If you missed only 5 major days of trading within the market, so we're talking about a 20-year period, you know, over 3,000, over 6,000 days. If you missed simply 5, your return would be cut in half. There'd be 268. If you missed 15 out of the 6,000 plus, your return would be 147. If you missed close to just 1 month of significant trading days, you'd actually have negative return. And so the idea of us trying to time it, sell, and reposition and trying to reallocate, it's a fool's game in terms of it's gambling, right? When we try to really honestly do that day trading, it's inefficient. And so that approach, while still recognizing the down markets, like when you see COVID and the entire market down by 38%, you can recognize it's a good time to buy. That would be a good time to buy, right? But in terms of trying to sell positions and rebalance, that this is what you'll get into when you start to dive into, when you start to try to reach into that cookie jar, right? But what you said at the beginning, recognizing the downs and taking advantage of the discounts, makes sense, totally good, definitely stick with that. But at the same time, consistency is key.
Just to clarify this graph and what you're referring, are you saying you need to put in that 100,000 in one of those key days? Or are you saying put that 100,000 over year one, like divide 100,000 by 12, and each month you put an X amount of money? Assuming you do that, then you will get the 424,760. But if you do not do that, if you start customizing it based on day, put in X day, this day, and this day, those are like the projected. So I guess to summarize it, are you saying put the 100,000 all as an initial investment regardless of the month, or are you saying divide it like over a year?
In this chart, what it's saying is the mathematical difference if you missed the best days over a 20-year period. Now, the reason this is important, and it's not going to directly answer your question, but I think it'll give you more context. We don't have a chart here, but historically speaking, the best 5, 15, 25 days typically come immediately after or in between the worst days. So the point is that it's really, really hard to time it. And the stock market is the only place that I have consistently seen people not be able to take advantage of things on sale. It's a psychological problem. So I think I gave this last time in the session where we talked about buying someone a purse. Shake your head if we talked about purses. No? Okay, so I'm going to tell this story again. Let's just say, Khaled, you're married and you want to buy your wife a gift and she wants a Birkin bag. And a Birkin bag costs $50,000. And you say, look, I love you to the moon and back. I'm not buying you a $50,000 bag, I'm sorry. But you also remember that she always wants it. And you're walking by the store one day and the same $50,000 bag that she had said she wanted is now $25,000. And you say, wow, it's chopped in half. Probably still not going to buy it because I'm not spending that much money. But it's the same bag, same place, same store, same materials. I guess they're clearing out inventory, right? There's got to be a reason, but they're getting rid of the bag for less. But you're not concerned about the quality of the bag or the prospects of the bag or the bag's ability to bring happiness to your wife. She doesn't know the price. But it's still too expensive because you are disciplined and you have a budget. And the next day you go back and now it's $12,500 because it's split again. And now you say, wait a sec. I never thought I'd spend $12,500, but the bag was $50,000. Nothing's changed. And I really do have $12,500 that I could spend on a bag. I should probably do it. And the only reason you don't do it is because it's out of your budget, not because you're questioning the quality, the integrity, right? In the stock market, people can't think that way. They just can't. It's the reptile part of your brain. You actually freak out and you get paralyzed. And you say, maybe I'll wait for it to calm down a little bit, or it could get so much worse. And then you find all the reasons why you shouldn't invest at that moment. Guess what? Those reasons were pretty much all the same reasons 3 days ago, 5 days ago, 2 years ago. You know, there's a saying that Wall Street or the stock market climbs a wall of worry. You know, if it was guaranteed, if it was clean, if it felt good all the time, there really shouldn't be much of a positive expected return because where's the risk? So the point of this is that it really is hard to time the best and worst days, and they typically come in bunches and together. And you don't know. It's not like for every A day there should be a B day. It doesn't work that way. You can have 5 A days and 1 horrific B day. Or you can have 5 horrific B days and 1 A day. You just don't know. It's a randomness return. It's like a drunk man walking home. So, you know, we have a general direction of where to go. And this is the point, right? Stay in that direction. Don't abandon the direction. The only time you should abandon it is if there's something personal happening where you need the money for something else and the risk profile is no longer matching what you're willing to accept on the volatility because you're about to buy a home and you know the home costs X dollars. I can't let this go down past this much because then I can't buy the home. So obviously on a personal level, there are times where you have disciplined approaches. We call them stops, limits, where you say, look, I have to tap out. I can't let it go more than this. And that's where like Chase and I work with people and we kind of formulate historically, no guarantees, but look, back in 08, 09, when the recession hit, or COVID a couple years ago, like here are examples historically of bad things. that we saw or didn't see. But here's how your portfolio would hypothetically have acted, and that's the best we can do. And then we match your risk profile up. So the point of this is stay invested. If you cannot put all your money to work at once, because mathematically that is the right answer, even though it doesn't feel good, the dollar cost average or DCA, you mentioned every month putting money to work. That is tried and true. It doesn't go wrong. So the answer specifically your question would be, if you're a net saver, put the money you have saved already to work immediately. It's always mathematically a better time now than to wait. With the new money you're saving every month, put it to work every month. And you'll actually have the best of both worlds.
Thank you. That was clear.
Is anyone confused by that dollar cost average comment that Michael made?
We got a
I
thumbs
missed
up, so I think that means that they understood.
I was gonna say, yeah.
I might have missed it. Was that covered in the earlier? I got
So-
here late.
So no, you're so fine. Yeah. So dollar cost averaging, because I heard that Mike comment on that term, and I just want to make sure that that didn't go over anyone's head. Basically, what that refers to is when you have, for instance, you get a bonus from your new job, right? A signing bonus. You get $10,000 in cash. It feels fantastic. You want to invest all of it. Instead of dumping the market on the day one with the $10,000, the idea is to make instead 4 monthly payments of 2,500, right? So on day one, you invest 2,500, leave the rest in cash. 1 month goes by, you invest, or 2 weeks go by, you invest another 2,500 and another 2,500 until you've invested the entire 10,000. The reason you do that is this: it averages out the value of where you're buying your stocks, right? So God forbid, if you buy it and all of a sudden the next day it crashes, right? Well, consciously we know, okay, well, in a week I'm going to buy that same stocks, those same stocks again. So I'll average out my return, right? I bought it up here. If I buy it down here, it's like I bought it here, right? And then you can keep averaging out. So instead of getting hit or crashed by a sudden change, you can average out exactly how much you're investing over a longer period of time. Now, obviously, the market could go up. You start here and go up. It's the same kind of thing. You're going to average out the overall term, so the volatility of the market won't affect you long term. It's something we do very actively whenever big, large sums of cash come into our investment portfolio and everything like that. Instead of taking all risk, but just investing it with day one, maybe space it out over a month period or a 2 month period.
With inflation as high as it is, would you want to more aggressively get your money into the market? Or I guess you just want to avoid like losing the buying power over time, even if you're trying to dollar cost average.
That's exactly right. There was a slide we used on our last presentation. Chase, do you mind pulling it up and showing
Pulling it
the
up.
comparison of just owning, I think it was the S&P 500 we chose, which is coincidental for you, Jacob, because I was just picking on it. But, it just said essentially put the money in the S&P and ignore, and then keep the money in your mattress and ignore, and which one is better for you. And you'll see the answer is pretty straightforward, right? And you've nailed it. You want to maintain at the very least your purchasing power. So we're talking about equities right now, but you can own bonds, you can own real estate. There are other asset classes available, and in a real constructed, disciplined, robust portfolio, you'll have lots of different asset classes, and their weightings will depend on your risk tolerance, your goals, your liquidity needs, income needs, right? There's a lot of other nuances that come into this. So just know that we're just showing you the S&P because it's a clean and simple thing to compare. But there are other ways where people say, look, people come to us all the time and say, I don't see my money going down in the bank, but I understand that it's not worth as much as it was yesterday. And it's tricky because I don't see it moving, but I know that I can't buy the same thing I could have bought a year ago. And, what can I do? But I really don't like the stock market. I don't want to go out and take risks right now in that. Well, okay. How quickly do you need the money, right? There's all these things, but there are ways that we can invest to at least do our best. And there's never a guarantee, but at least do our best to keep up with inflation so that after fees, after taxes, you're at least neutral, right? And most often the case, people eventually get more aggressive because they realize this is silly. What am I doing? Right? Why am I just trying to keep with inflation? I'm like literally treading water forever. This doesn't make much sense. I actually want to swim somewhere.
Also, and Adam, then I'll get to your question. The one thing I want to emphasize too regarding inflation is scary, and the news makes it seem like a very scary concept. It is. It's a changing of the dollar value, but it's also something not to be feared because it's natural. It's been happening since the creation of money. And so thinking about it, where obviously we talk about the value of the dollar and what it could actually buy. $5 bought you a lot more back in 1920, but we also consciously have to understand that other things, the environment, the market itself reacts and responds to inflation as well. People made a lot less money back in 1920 than they do today. You look at the average employer wage, 60,000, whatever it is, like that was an unheard of salary back in 1920. So when inflation does go up and the prices of goods does go up, so do prices in real estate. The values of homes go up. So do commodities go up. So do our salaries. So do every Social Security. Everything adjusts with it. And so while it's intimidating in the short run, also just consciously knowing that the really only area where inflation can detrimentally hurt you is when you have your money sitting idle, right? If it's not in an area where it can respond and correct with the market, for instance, the S&P 500 corrects with the market, well, then that's the only time it's going to hurt you. Adam.
Oh, hi. I actually had a question about the dollar cost averaging. I'm not sure if Jacob has his, are you okay with me asking a different question?
Yeah, go for it.
Okay. Yeah, I just want to ask, does the DCA apply to selling as well? Because he said like we average over the buying period and then we'll be more resilient towards the ups and downs. But what about selling? Like, how do I how do I know when it's a good time to sell?
So I'm gonna go back. I'm going to ask you a question. Why are you selling?
To sort of time the market, I guess. Yeah.
So then you know the answer already. Now, if you were selling because you needed income, right? There are plenty of clients we work with who have already accumulated wealth somewhere else, and they need our help distributing wealth, whether it's altruistic, where they want to send money every month or every year out of their foundation to a nonprofit, right? And help people and causes close to them. Or they may want to send money to their relatives, or they may want to just spend money, right? They're retired. Let me live better, right? Our goal for most of our clients as a general statement is that we want you to retire and earn more in retirement than you were in while you're working. Like that's a good retirement in my mind. So our goal is let's accumulate and compound so that you get to a point where we can then pay you every month a salary that's equal, if not better, than what you were earning while you're working. So you retire on your terms. It doesn't always work that way, of course. But in that situation, yeah, we absolutely, we don't, if someone needs money every month or every year, because we can create the equivalent of a salary, we're not going to sell it all January 1st, have it in cash, and then every month give them the money. We want the money to always be working for you. So each month we'll sell down the amount we need and distribute it to the client in their bank account. Same thing, there's a thing called required distributions. And we talked a little bit last time about IRAs and Roth IRAs. And the main difference on the back end of those two types of retirement accounts is one has a required distribution, and that's called the regular IRA. And that's because the government wants their money because they're going to tax you on it. And they say, look, Adam, Chang, Jacob, Jeremy, whoever I'm talking to, you put money away for a long time and you didn't pay any taxes on this. Not only did you not pay taxes, we actually gave you a benefit by lowering your taxable income. Now we need our money and we want it now. And they'll say, okay, well, your life expectancy is X number of years. So we're going to divide it by X number. You have $1 million in there and we think you'll live for another 20 years. So 50,000 a year you have to pull out. And we expect that account to be flat by the time you're X age. And every year we take it out, you pay taxes on it. So in that situation, we do the same thing. We don't want to take all the money January 1st and distribute it because you were in a tax-free environment for another, the rest of the 50,000 or all of the 50,000 could actually wait till December 31st and compound the whole year. because every day there's expected positive return. It's roughly 55% of the time you should make money every day. Now we know it doesn't work out that way, and it's not linear where if you make $1, you can lose $1, right? You can make 4, you could lose 10, it goes all around. But statistically, just for the same reason why we say put all the money to work today, statistically, we want to wait as long as possible to the last possible day to take the money out of a tax-deferred or tax-free environment. Because, if someone's telling me I go to the casino and I can get a 55% odds, I'm going to play those odds all day long. That's the best odd in the whole casino. And it doesn't exist, of course, because the casino would lose money. But at least in the stock market, you can treat it a little bit more like a casino and take advantage of the edge.
Adam, answering your question one other way as well. When it comes to, because I think you were also alluding to in terms of just investment performance, right? So not actually leaning on your money for income or to give to your parents, but is there a good time to sell strategically in order to increase my performance? And in terms of that, it's again, that gets into our trying to time the market, right? It's not beneficial to do that. Now, there are things like, for instance, capturing capital loss, and there's this thing called short-term and long-term capital gain. So without getting too far into the weeds, capital gain tax, right? If our money starts at 10 and grows to 20, which is great, we have to pay tax on the $10 of growth, right? We put in 10, that's tax, that we take that out, but the gains, we have to realize tax on it. The government wants to get their portion. If we haven't been invested for longer than a year, so a year is the cutoff, it's short-term capital gains. It's much higher tax on it. But if we hold whatever position we're in for longer than a year, then we're immediately put into long-term capital gains, which is a much lower tax burden to us. So in terms of one, just consciously thinking about investments, we like to at least keep them for a year, right? That's a good goal to be setting ahead. And then at the same time, whenever you're going to be selling, it should be for some purpose, some reason that you need the money, right? Otherwise, we want to be invested as long as possible. Now, also take into consideration, if you're put all your money into Meta or Facebook or whatever they call themselves now, and it goes down by 50%, right? Realizing that there are some moments, obviously Facebook is a very established company, so I doubt that it's going to be leaving permanently anytime soon. But if you're taking advantage of a risky stock, right? There's a long shot that you heard of, and all of a sudden it goes down by 85%. Knowing when to sell, not just being tied to that anchor, is also just consciously be aware of that as well, right? Just make educated decisions, but all in all, ride it out and let the market correct itself as long as you can. Touching back on Michael's point, you want to be invested as long as possible.
Gotcha. Yeah. So I guess only sell when I need the liquidity, I guess.
It's a good rule of thumb.
Yeah, as a general statement, but if you know you're going to need certain amounts of money, then just like you could have a glide path on accumulating, you could have a glide path on removing, right, or taking apart. So I wouldn't necessarily blanket state and say hold as long as you can. I gave you examples where it made sense, but at the same time, if all of a sudden you're about to switch to retirement and you say, Michael, Chase, in 5 years I'm going to retire. Here's my goal. Can I do it? And we say, yeah, of course. Yeah, you did a great job saving up to this point. We're so proud of you. Let's do it. And as we get closer, we already know the amounts, and we just kind of every year touch base and make sure they haven't really changed, right? Inflation, et cetera. There may be things, maybe you relocate to a lesser, more expensive area. Maybe you're going to live international and there are currency exchanges we need to be aware of. My point is that as we get closer, we'll probably start to de-risk some of the portfolio or maybe change some of it to be more income generating, where we sacrifice potential growth, but we're increasing the revenue we create and the interval in that revenue to be able to afford the upcoming pull we're about to have. So it's not a blanket statement. It goes back to that comment I had earlier, I think to Jacob, which is every person and their circumstances are just unique and different. They're obviously common patterns, but at the end of the day, everyone has their own needs and their own priorities and their own concerns. And our job is to figure out how to address them and walk that fine line and get as much as we can out of the portfolio without putting the client in a position of losing.
Yeah, I got it now. Thank you so much.
Conscious of time, I know, Tanny, how long are you able to go past 8? Just because I know we started a little bit late, like 8:10ish, 8:15 at maximum.
I'd rather open it up and just, if anyone else has any questions. I don't
Yeah.
think we need to necessarily go through any specific part of the presentation. I've
I
liked
agree.
the flow. People have been open. So I would just say for another 5 or 10 minutes, you want to fire us off questions, and then we'll wrap it up. We don't need to check a box at a certain time. But
Yeah.
feel free. Anyone
I know-
out there, raise
I
your
know-
hand.
I know I do want to leave at least 2 minutes just to run through the Excel spreadsheet with them, just to show them. We could also show them the compounding calculator, just because that's a interesting thing to walk through. But that at least then they at least get exposure, and anyone else who, because obviously we're going to be sending this material out for people who receive all the information and they're like, well, how do I use this Excel spreadsheet? They can at least come back to this recording, and it should be a nice, easy way to step-by-step guide. How do I use the material? So I want to leave at least 3 minutes for that at the end. Yeah,
So
but
I pushed unmute on everyone, and I think Tingwei took the bait. So if you have a question.
I don't really have like a specific question. I'm just trying to, because I'm not really knowledgeable in finance stuff, so I don't want to try not to make the worst mistake. That's So I'm trying to do.
okay, yeah.
So
And
maybe Chase, maybe can you talk about something? Can you just share an example of a bad mistake you see people have done? Could be on anything we talked about today or something else that you've seen.
Or something that you're trying to avoid doing.
Yeah,
And
exactly.
change.
I mean, we see
Yeah.
things all the time that
Yeah.
people make mistakes.
Yeah, all the time.
So do you have an example of one that you may want to share that you've seen? Chase? No, it's Chase. I'm sorry. I was asking you. Do you?
Oh, you
do
were
want to
asking
share
me.
one with the
I
graph?
thought you were
Yeah.
asking Tin Wei. I thought you were asking him. No, so I guess the example that I've seen is really when it comes down to people who are just starting to get a salary, they really struggle when it comes to understanding where their money's going, right? So they might have aspirations, they might know that it's good to save, but trust me and just get really comfortable with this in the first couple of months of starting to see a salary, starting to spend on other things, having a good understanding of what your cash flow is. So again, reiterating what's coming in, what's actually coming in, right? Take into account the taxes, take into account how much money they're pulling out for your 401ks, your other contributions, whatever it is. What is your paycheck? And then compare that to what am I spending money on? And then be diligent with it. Because at the end of the day, you are going to hopefully, fingers crossed, become higher and higher income earners, right? But you're going to set your savings habits now, right? If we don't set a priority for saving when we're young, it's going to be very hard to switch gears and start trying to prioritize savings when we're later. So right now, all this 20-year period, understanding that we have time to figure it out, right? Our 20s is when we figure it out. But this is really and emphasizing the point. Don't be afraid to make mistakes right now, but more use this opportunity to set good habits, understand where your money's going, and just get it invested, get it exposed into the areas that we've started to really discuss. I think the number one area is people wait to save until they're 30. That's the biggest mistake. Anything else, you're better than the majority of people out there. So don't be too scared.
Okay.
Yeah. Shane, I know you. I think I remember seeing that your hand was raised.
Yeah, I have a question on my hesitation on committing, I guess, which is what platform am I committing to, and like especially for a year as well, and the cost of switching, say, platforms. Say like I have a BOA or a Chase, they have investment platforms, or Fidelity, or does it really matter? Like either way, right?
That's a really
Great question.
loaded question. It's a great question. Chase, do you have that slide of the comparison between the two that we like to show?
When it's up, the
Fiduciary
slides
versus
between.
non?
No, we don't have that slide.
We don't have,
Every
okay.
Yeah.
No worries. So let's just talk about it then. No problem.
Okay.
So full disclosure, Chase and I, we're fiduciary advisors. And it's really important, and we talk about this with everybody we meet with. Obviously, we think we're on the right side of the equation here, and other people will think differently. So it's not a straightforward, this is what you have to do if you talk to more than one of us. But you basically have two verticals. Oh, perfect. There you go. You have two verticals in the wealth management industry. You have the fiduciary, and then you have the broker. So brokers on the left on the screen we have in front of us, fiduciaries on the right. And we're on the right. We think we are in the right, no pun intended. But I came from the broker model, and I thought I was doing the best I could back when I was doing it. And I don't regret it. I don't question it. But now that I've left that orbit and I see the difference with a clear set of lenses, I tell everyone, don't even think twice, go the independent advisor route. And the basic concept is that in our industry, it gets a little shady, unfortunately. And you can meet with someone who is on the left side of this equation, the broker side. And I'm not going to name any specific companies, but there are a lot of the big names you mentioned. And they can switch their hat between selling you a financial product and advising you without legally having to tell you which time they're doing which. We think that's just totally unfair. It's morally wrong, and it should change. Our side says, look, we don't get paid differently based on which product you're in. And if there was ever a situation that we would get paid differently, we have a legal disclosure, legal obligation to tell you we would get paid differently. And here's why we still think it's a good idea for you. And then you as an educated consumer can say, no, thank you. Or, okay, makes sense. The other thing that I want to harp on real quick, because I said this is a loaded question, I could go for an hour on this topic. The broker model generally, not only are they a big company, but they control and print and send you all the communications. They send you the statements every month, the trade confirmations when transaction occurs, the tax documents at the end of the year. They control the website you go on to see. On the independent advisor side or the fiduciary side, we purposely don't control the money. That sounds kind of silly because we manage money for people. We have a legal obligation and a legal right to push the buttons for clients, but we never hold the money. We never generate the reports from where the money's being held. So it's monthly statements, we don't see before our client sees them. Trade confirmations, we don't see them until the client sees them. Tax documents, we don't see them until the client sees them. And the reason this is so critically important is that if I'm going to someone to help me with my money, I want to make sure that they are properly compensated to act in my best interest and sit on my side of the table. I don't need them to shove something down my throat and get paid, number one. And number two, from a safety perspective, I want to make sure my money's safe. I understand the market goes up and down, but what I don't ever want to hear is that you are a Bernie Madoff. There's some kind of situation where you actually lost or took my money. And by having no control over the investment statements and the trade confirms and the tax documents and the website, that can't happen with someone like us. Now, hopefully it never happens anyway, but it can't happen because you'll know right away. Bernie Madoff, when he was caught, he was the first thing he said is, when they asked, how'd you get away with it? He said, well, I controlled all the communication. So I think very strongly, now of course I'm biased, but I think very strongly that if you're going to work with anyone, you want to work with an independent advisor who's a fiduciary, because they'll get you all the same access. It may even be less expensive, but you always know that they're in your corner helping you. They're not selling you something.
Yeah, that's great. Thank you. And I saw that from the first session as well. I was having, I guess, problems identifying who are the brokers and who are the independent advisors. And also, if I'm investing on a platform, right, I feel like I'm not talking to someone who's managing my money. So if I pick my own stock or pick my own ETF, that's unrelated to the platform, whether it being an independent advisor or a broker, right? So those are two questions.
So the answer is yes as a general statement, but don't think that just because you're not talking to someone and you're using a platform doesn't mean it's costing you. And this is where, again, our industry is just not super transparent. There are plenty of platforms out there where there's no cost to trading, there's no advisory fee. Basically do whatever you want. Here's your money. Here's our model. We think you should do it. Well, A, they may be getting a finder's fee by plugging in specific products, right? So they're not charging you and you don't see it, but they're getting money on the back end by strategically selecting which products they would like you to have as an option. But more effectively and more profitable for everyone except for you is they're legally allowed to front run your trade. They're legally allowed to sell your order to a high-speed trading company, high-frequency trading company. They're allowed to literally sell your order before you execute. So while you only see the difference of half a penny, right? And in context, you would say, well, it's fine, just take my penny, I don't care. You think about the millions and millions of dollars changing hands every second of every day, and if every one of them has a penny, it becomes a really big amount very quickly. And there's a reason why certain companies out there who are high-frequency trading companies make a fortune. In fact, there are some companies that have never lost money in a day. I mean, that should tell you enough of how the rules are kind of, goofed up. So just know nothing's really for free. What I tell everyone is that ETFs are a great way to get access early if you don't need or don't think you really need too much help, but you just want to get started. Phenomenal. Go buy the World Index Vanguard ETF. Costs you almost nothing, and you own 13,000 companies around the world. It's really incredible. But at some point, as you start to accumulate wealth, as your circumstances change, you're gonna feel something in you that says, I should probably start to talk to someone because there's clearly more happening in my life than just this one position, and I really want to make sure I do this right. And that's when you want to go back to the vertical broker versus independent advisor. And to answer your other part of your question, generally speaking, 97% of our industry is that broker model, 3% is the independent advisor, and that's by number of people, not by assets. By assets, like 99 point something versus point something. So the odds are extremely high that you are most likely interacting with a broker more often than not.
To answer
Thank
the
you.
question again, yeah, just look into the fees associated with it. Whenever you open up an account, they have to provide you with an investment advisory agreement and all these other things. Just give it a quick read. See exactly how much you're paying for transactions. Any other questions? We have a nice little 5-minute gap here. Otherwise, I think I'm going to share the screen really quick, run through the tool, one of the tools that we'll be providing, and then I think we'll call it a night.
Hi, follow up on that.
Yeah.
So for the independent advisor model, the business model for that would be, I'm assuming, correct me if I'm wrong, I'm assuming would that be like a per hour basis for advisory, and where would the money go? Is that also going to a specific channel or platform, or and how does the payment model works for getting that kind of service? Is it depend on how much I'm investing and my income, etc.? Of course, I know like all these are personal and sit down, but I want to get an idea on how that works.
So reiterating, as fiduciaries, we are the example of that. We can only charge one way. So inherently, we can't have any bias towards any types of advisement or commissions or any types of products. And so the only way we're allowed to charge is at direct assets under management fee. So when it comes to hours, we're not lawyers. There's no payment for our time, anything like that. It's directly how many assets we're managing for you. That's where the fee is associated. So 1%, 0.50, 1.26, whatever it is. So that way it keeps us on the same side of the table as our clients, because the only way we can increase our fee is by growing your assets. So it keeps us and our objectives aligned. Yeah, so that's usually the way it's operated in that sense. I'll let Michael talk a little bit more in case you have any further questions, but I'm going to start to pull up that Excel spreadsheet that we're going to want to review.
The only thing I would add is that how we work and the transparency behind it is clients know what they're paying at all times. They know the schedule. They know conceptually what they're paying for, and it comes right out of their investment accounts. They see it every quarter. So 4 times a year, we pull a fee. It's transparent. It goes back to us not controlling the communication, right? So the client sees the statement. They go online. They'll see the transaction. We're very proud of our fee because we're confident the value we're providing is above and beyond that fee. So there's no reason for us to try to embed it or try to hide it or try to make it seem a little bit more difficult to find. It's quite the opposite. We want you to know exactly what you're paying and what you're paying for and be very happy with what you're getting.
So something diving right into this, just being conscious of time. A lot of people are asking, I'm about to start. I don't even know where to put my money, everything like that, right? This is a tool that we've created to hopefully help to at least get your mind thinking, addressing them, and being able to record all the variables that we've been talking about, right? At the end of the day, when you first enter into the workforce, if you can have a consistent plan on how to keep track of all of your variables, you're going to be successful. That should be your number one goal, understanding exactly where your money is and how it's flowing. So again, direct email support, you click that button, it automatically pulls up our emails for you. Michael's contact information there. A quick step-by-step guide, table of contents. So if you click any of these buttons, it takes you to the area that you need to fill in. So for instance, if we click area 1, this first tab here, assets, this is where you can record how much cash on hand do we have. So let's say, for instance, we had $10,000 cash on hand. How much investments do I have? The number 2, right? Taxable investments, the wealth building account. You put that in there. Let's say we had 5,000 in there. Your 401ks, you can start to track that here. Your IRAs, if you start owning any residence, some rental properties, all of that's being able to be tracked here. It's and the total is calculated at the bottom. Keep going. Liabilities. A lot of people are going to be potentially leaving school with student debt. Imagine if we put in here $25,000 in student debt, you were able to record your interest rate as 5. Your goal is to pay it off in 10 years. It calculates your monthly payment right there for you, right? So automatically generates, it's able to help you keep track of everything. And again, there are these little white boxes that pop up when you hover over the cell to help explain it further. And then at the bottom here, we have your total net worth. So how much are you worth in terms of all your assets combined minus your liabilities, right? So for some people, it might be negative, right? We might have more student debt than assets that we've accumulated. So things just to keep into consideration, right? You can put in your salary here. Let's say we're making $80,000 at the beginning. You can put in your bonus, et cetera. Start to plug in a lot of these variables. And then one of the last sections to touch on, this is probably the number one I would really focus on as you're first coming out, because we want to get an understanding of what am I spending, right? Where is my cash flow? This is a great tool that, again, like your student monthly payments will be plugged in here automatically, but this is a great spot to just go through, look at all these different items and just help you just start understanding where's my money going. We've highlighted the boxes of blue that most of you out of college are going to start to be spending money on. So like for instance, let's say we're paying $1,300 for our monthly rent. Let's say we are spending $500 on groceries, dining out, we spend $300 a month, whatever it is, you can start to set goals and we'll calculate it here at the bottom, right? And then again, understanding where our monthly net paycheck is, we put that in here. So let's say for instance, where our monthly net paycheck is $3,500. So we have a savings potential of 1,000, right? Actually, I'm going to make this a little bit higher. Let's do 45. Now we know exactly how much we're saving. This is the last slide that just again help provide some direction on how much money should I be putting into different areas, right? So coming to this savings allocation breakdown, your total savings is put up here. And it actually compares against how much is your salary, how much is your savings potential, and how much can I save if I'm able to actually save this total amount. If you're above the 10, you're in the green, which is great. So for here, if you're able to save $2,000, you're above the green. Coming down here, again, we said that no one person is going to have the same model. So you can choose your risk tolerance here. So let's say we choose moderately aggressive. It actually gives us an allocation breakdown and says, okay, how much cash do I need on hand? How much funds should I be putting towards a Roth IRA, my general investment account, et cetera, right? So for instance, here, we said we need 4 to 6 months, right? Let's say you felt comfortable with 6 months of monthly expense. Based on the budget that you calculated, if you want 6 months of monthly expense, you're going to need close to 14,000. This Excel spreadsheet will be smart enough to recognize that if this cash on hand isn't above 14, then it's going to say that this goal isn't met yet. Oops, sorry. That this goal isn't met yet, right? Now, the moment this drops below, so for instance, we do have, for instance, 4 months. This is below 10,000, right? So it turns green, boom, and it updates and says, all right, now that we've met this goal, if you're in the overachieving section, you should be putting this percentage, this month, this much money into your general investment accounts, right? It's a good way to help keep you on track and keep you on pace to see where should my money go. And again, we have a nice little quick overview, some of the key benefits. For instance, a Roth IRA, grow tax-free retirement money, protect your assets from taxes, lower your retirement income bracket, a lot of the concepts that we brought up, and just goals and trackers to help keep you on pace. It's a great tool to use just to start getting your feet exposed, dipped into the water. Any questions on this really quick? And while people potentially formulate stuff, this is the last piece of material we're going to provide for you as well. It is like we said, that within the presentation itself, were a bunch of links to help you in case you wanted to do some more due diligence, do some research, like for instance, credit reports. If you wanted to look into credit cards, here are some more options and links for you to do a little bit more due diligence, a little bit more research, right? How much should you be spending on rent? These are rent calculators. How much company match should I be putting in with my 401k? This helps to articulate that. How much credit should I be doing? Best credit cards here. Creating a budget, there's a different financial tool here. It's just a couple resources for you to break down as well. So all this is going to be included along with the recording of tonight's session. And so please feel free, go through it. And again, of course, reach out to us with any questions on anything. If you want to meet individually, talk about your personal situation and get some more targeted advice, more than willing to do that as well. Any questions on anything? Jacob.
I was just going to say thank you so much, and I'm sorry if I missed it, but where are we going to be able to access the spreadsheet and recordings?
We're going to be sending, so very similar to how the Zoom invitations were sent to you, they're going to be sent to that as well. We'll email them directly to you because you registered online. Everyone will be receiving it.
Okay, perfect. Thank you.
Of course, and expect that email with all the material and information either tomorrow or the day after.
Okay, great.
Of course. Any other questions? No, well,
All right.
So yeah, so appreciate everyone coming tonight and being a part and making this session very interactive. I mean, those are always the best. Feel free to reach out to us with any questions, but otherwise, no, thank you for everyone who participated, and this was a blast.
Yep. Thank you,
Thanks,
guys.
everybody.
Thank you so much.
Good night.
Thank you,
Thanks, guys.
Good night.
Good night.
Night.